Okay, so good morning, gentlemen, and good morning, everyone. My name is Vu Kiet Tran, and I'm a physician. I'm a family physician. I am an emergency physician and also a long-term care physician. And I'm also the president of the Canadian Physicians Pension Plan. Today, we have a webinar and a podcast with two other gentlemen because we wanted to address some of the questions that accountants have for me and in regards to the Canadian Physicians Pension Plan. So let me introduce our two guests today first. First is Normand Houle. Mr. Houle is a accountant and a CPA. So I'll let Normand introduce himself first, and then we will introduce Mr. Jean-Pierre Laporte, who is a pension lawyer. So I'll let you guys introduce yourself. Normand, please go ahead.
Hi, I'm Norm Houle with Houle & Associates, Chartered Professional Accountants. We're based in Ottawa, but we have a specialty with physicians as clients and always here to help and go above and beyond for our clients.
Thank you very much.
I'm JP Laporte. I'm the president and CEO of Integris Pension Management. I'm a pension lawyer. I'm also the treasurer of the Canadian Physicians Pension Plan. And I've been practicing pension law for 22 years, and we're based in Toronto.
Okay, thank you, gentlemen. So it sounds like out of the three of us, I'm the one with the least knowledge about this. And so that's why we have two heavy hitters today answering some of the questions. So here's why we're here together, gentlemen. When I talk to potential physicians who want to join the pension plan, obviously they have their questions and they have their concerns, and I answer them. But they come back and say, hey, by the way, my accountant also have concerns and they're not familiar with this or they don't know this. Here are some of the questions they have for me, and therefore I'm asking you, Vu. And I'm like, good questions. I'm not an accountant, so let me get the accountant on the line. And so thank you very much, Normand, for coming and doing this for us. Normand, before we begin, can you tell us and the audience what is your familiarity with the Canadian Physicians Pension Plan, but also with the PPP, which is the Personal Pension Plan?
All right. Thank you, Vu. I was introduced to the personal pension plan concept several years ago by my own financial planner and JP at the time. And we're always looking for solutions for our clients to support them. And this seemed so good that I jumped on board. I actually set up a personal pension plan within my corporation and am able to help our clients not only in the setup, but the ongoing administration, if any, for the pension plan. And this way, you walk the walk and you talk the talk. So I felt that it was important for myself to develop one for our firm and really see the benefits and not looking back.
Well, thank you. I think what you're doing is fabulous. Not only you did something fabulous for yourself, but also for your clients. And I thank you for that. So are you guys ready for the questions?
Yes, sir.
Let's go. So here's some of the questions that our physicians have asked me. And this is obviously coming from the accountant. So I'm going to give it to you, the questions from the accountant's perspective. So here's the first question. Having a client of mine join the Canadian Physicians Pension Plan, does it add much more complexity to my work as the accountant?
Well, as the accountant, not really, because the payments going from the corporation into the pension plan are nothing more than what we call employee benefits that are tax deductible expenses that are recorded on the books of the corporation itself, along with the corporate tax return. So it's no different than if they were putting money into an investment vehicle or an investment account, if you will. This one just happens to be off book because of the Pension Act, but it doesn't not add any additional work for accountants.
Now, I understand that for the RSP is something as, adding one or two lines on whatever you guys do when you file. And for us and for JP at Integris, there's a whole bunch of paperwork, legal paperwork on the legal side. From what you're telling me from the accounting side, not much more.
No, no, you're right.
So second question is, what are my responsibilities as an accountant when my physician joins the Canadian Physicians Pension Plan?
Well, first of all, just being aware of the plan itself and the benefits to your clients, and accurately recording the payments to the pension, the fees that are tax deductible as well by the corporation, and really keeping track of the client's desires, and obviously working with their financial planner who still manages the funds within the plan, to make sure that we're accurately recording those payments on the books.
Are there extra forms or additional forms that the accountant must submit?
Not the account. Well, I'll say in my case, I'm working with Jean-Pierre Laporte from Integris, who handles, I'll say, the legal / administrative side of things for a very small fee.
Okay.
There are no specific pension forms that the accountant must complete and file. Any such forms are done by the administrator, not the accountant.
Okay, got it. So when the physician joins a Canadian Physicians Pension Plan, Integris have a few forms they must complete. There are some legal aspect that Integris must complete. And from the accountant's perspective is really accurately reporting the payments and the tax deductions.
That's correct.
Got it. So question number 3, guys, there are lots of questions, so bear with me here. From a tax perspective, why is the personal pension plan, the PPP, inside the corporation better than doing an RRSP on the personal level?
So my view with that is that first of all, you're using corporate dollars, where the tax rate in Ontario, for instance, is just over 12%. So it gives you an 88 cents dollar to invest, so to speak. But because the pension payment is tax deductible, you're already saving that 12% up front, along with the fees. So you're using corporate dollars. It's off book. So that means it's also creditor proof. So if something goes sideways with your corporation, under the Pension Act, these monies are protected. They're somewhat protected in RSP, but not as much. But the advantage I have with the corporate investment, if you will, is that at age 71, where most people have to convert an RSP into a RIF, and now the government is telling you how much money you have to take out to retire. If it's left inside the corporation, you have full control as to how and when you're going to pull that money out. And obviously you're up to, you can also do income splitting from the corporation at that point as well. So my preference is always to use corporate dollars, have the corporation pay not only the pension plan contributions, but also the fees.
If I may jump in, it's also that when you count dollar for dollar, the pension rules will allow you to put 3 to 4 times more money than an RRSP over a lifetime. So it's not just that it's taxed differently, it's the quantum of the amount of money that we're talking about is apples and oranges. So if the business owners or like the physician's goal is to have the biggest possible nest egg, well, you have to use a solution that gives you those higher limits. And I think that's where the PPP really shines as opposed to an RRSP.
So jumping into the next question, because they're tied together with this, is some of the clients that ask me, and also coming from their accountants, is what other tax advantage are there of doing the PPP inside the corporation? You've mentioned 2 of them already. Are there other tax advantages?
Yeah, I mean, in the end, you've got some flexibility with how much, obviously, we're contributing. So if somebody, gets to the end of the year and has a high profit but excess cash, well, an extra payment to the pension plan will allow for that. And the advantage with the PPP as well is you can also over contribute in a sense. This is what JP was mentioning earlier, is that the limits are somewhat higher than an RSP. So therefore, I can reduce my taxes at the same time as building up my pension plan at the end of the year. And again, it's creditor proof. That is a big plus, especially where we're starting to hear about malpractice suits and things like that. So this is another way of protecting your retirement funds.
The other point I'd like to throw in, Norm, if you don't mind, is the fact that my understanding, and you're the accountant, so you can correct me if I'm wrong, but my understanding is that if you build up too much passive income inside of your corporation, then it's going to start having an impact on your $500,000 small business allowance, where you're taxed at a low rate. So by moving those passive dollars off the balance sheet into the pension plan, we're not attacking that $500,000 amount. We keep it in place and therefore benefit from the lower tax rate for longer. So that also reduces the corporate tax bill of the physicians corporation.
You're absolutely right, JP.
Yeah.
And gentlemen, there's one more, which is the intergenerational wealth transfer aspect of the pension plan that really doesn't exist inside the RSP, because in the RSP, there's such a little thing called the deemed disposition at time of death. So in the RSP, you cannot truly transfer the wealth to the next generation without being taxed. So there's another tax advantage of the personal pension plan and the Canadian Physicians Pension Plan sitting inside the corporation.
That's correct. And it's something that most people have never heard of, unfortunately, because pension legislation is really something that we see with the large government employee pools or with unionized workforces. But in the small private sector where the physicians are operating, they've never heard of any of these concepts. And even their accountants, most of them have never heard of any of this stuff. So it's all new territory for them. And yet this could be millions of dollars saved by the physician's family should the physician pass away.
Okay, so here's
Yes.
a question. Oh, go ahead, Norma.
Oh, sorry. And if you have a family business, just stepping aside from the physicians, if you have family members that are working within the corporation, the PPP allows you to transfer that pension to an intergenerational transfer, I'll call, and keep it alive.
That's right.
And this is not just for one generation.
Correct.
That's right.
This could go on for multiple generations.
Yeah. Some people use family trusts to try to do that, but the problem with the family trust is there is a deemed disposition every 21 years. Whereas with a pension trust, which is what we use for these solutions, the 21-year doesn't apply. So it could go across multiple generations or across centuries.
Okay, so here's the next question, which is very important because I would be asking the exact same question. Is this a legal solution in the eyes of the CRA? And if I'm the accountant and I'm proposing this, or I'm suggesting this, or asking my client to consider this, what risk am I taking as an accountant?
Okay, so I'll let JP jump in on the legal side of it, but from the accountant's perspective, I always advise my clients, I cannot sell you a CPPP, I cannot set it up for you per se, but I can only give you the advantages, if that's one of the solutions that you're currently looking at. Yes, there are legal aspects, but because it falls under the Pension Act, I'll turn it over to our pension guru, JP, to explain that one for you.
Yeah, so the plan is anchored and forms part of the legislation under the Income Tax Act. So the Income Tax Act has provisions that deals with these types of pension plans. And they're called either individual pension plan or registered pension plans. So it's all based in government regulations. And the government has to approve and register these solutions, and then they keep monitoring them on an annual basis, and they can even audit them. So this is not some sort of a transaction that you do, you know, in some foreign country, and you try to claim some tax deductions. This is a government approved, regulated, supervised solution. So of course it's legal.
And so the question is, if I'm the accountant and I'm proposing this, not that I'm setting up, but I'm suggesting this to my physician client, do I have any risk?
Not at all, because basically you're just advising them, you're proposing a solution, but ultimately the final decision rests with the client, with the physician. We're trying to help them make an informed decision. We're just educating them. So there is no risk.
Okay. Were there recent legislative changes that make this a better solution now than a few years ago?
I'll probably want to jump in here because it's more legal related. So the answer is yes. There were some changes in Ontario in December of 2020 that made it a lot easier to set up these types of pension plans inside of a professional corporation for a doctor, for example. Not just doctors, but since we're speaking about doctors today, physicians, that made it a lot easier. So that's number one. And number two, the federal legislation has changed in such a way that if you keep too much passive money in your corporation, which is what a lot of people have been doing, you're penalized. So being able to take those dollars off the balance sheet and putting them in a pension plan, which is now easier to set up, makes it even better. So yes, there have been federal and provincial changes recently that makes this solution a lot better than it was, let's say, 3-4 years ago.
Okay. Normand, did you have anything you wanted to add?
No, that was it really. The federal government, federal and provincial governments continue to make tax changes, as we know, every time a budget comes out. But I think the CPPP will be very much protected under the Pension Act going forward.
Okay. Now, this is a good question that I get all the time, and I'm looking for you guys to help me answer this. And here's the question is, I do not know a lot of colleagues doing this. Okay, none of my accountant colleagues are doing this. None of them are suggesting it be done. So why is it not more commonly suggested or considered by accountants out there? What's the explanation for that?
Well, it's just the exposure that they have, and I'll be honest, the pension plans are very specific with regards to tax rules and the like. And I'll say the stereotypical average accountant is more concerned about debits and credits and filing tax returns and not really providing advice to their clients. And so that's what kind of separates Houle and Associates in a lot of ways, that we really care about our clients, and we will investigate and learn more and more about options that they have to invest, whether it's inside the corporation, outside the corporation, or anything that will allow them to live a better life and ultimately save them time and money.
Well, I think most accountants, I can't say all, and there's never absolutes in life. I think most accountants are very protective of their clients and want the best for their clients. But to your point, if you're not exposed to it and you have not been familiar with it, then you wouldn't know. And in the realm of accounting and financial planning, it's a team sport. I always say emergency medicine is a team sport. I rely on my nurses to make sure that my patient is well taken care of. And I don't think it's different for accountants. And so if the financial planners in your circle is again not exposed to it, then you are most likely not exposed to it as well. And I think it does take time for that awareness to build.
I agree. Yes.
Okay, so who does this implementation? Is it me, the accountant? Am I implementing this? Do I have to do all the paperwork and the administrative work? Who does this? And what is my role as the accountant?
My role as the accountant is really to work with let's say JP in this case at Integris, to gather the information they need to set up the pension plan. Obviously, we're looking at clients that need to pay themselves a salary because the pension plan contributions are somewhat based on, our RSP limits to a certain extent, but also if the client is unfamiliar with the pension plan and the ins and outs of managing money, definitely we work with Integris in the initial setup.
Okay. So what you're saying to me is, as the accountant, your role is really limited to the transfer and the accounting of the information. You're not building the information, you're not building the numbers, you're not filing with CRA for, legal applications and all that. Your role as the accountant is really like you would for any accounting for RSPs and TFSAs.
That's correct. Yes. We leave the legal side of things with a company like Integris and JP.
Okay. So I guess the next question is very similar. Does this require more time for my staff?
As an accountant, no. It's just, again, making them aware that you do have a pension plan. Let your accountant know so that it's properly recorded and accurately included in the accounting and tax reporting. But I wouldn't say it takes additional time to have a pension plan, if you will. Obviously, as a value-added accountant, we have fixed pricing for a lot of our services. I don't typically charge by the hour, but if the accountant is billing their clients by the hour, then yes, if they feel there's additional time and they're able to bill for it, by all means, it is legitimate work that has to be done.
Got it. So here's the next question, I think very legitimate question. How much education does an accountant need to acquire in this area before they could mention it to their clients?
Well, the pension plan itself falls under tax-deductible employee benefits. So I would say that an accountant has to be familiar with the tax deductibility of these pension plan contributions, as well as the tax deductibility of the fees. And also, as JP mentioned earlier, also keeping an eye on those new passive income rules that the government introduced and seeing where we're not allowing a client to accumulate so much excess investments in a corporation outside of the pension plan that might lower their net income after taxes. So this is not an area that is very over complex to learn, but it does take a little bit of time and some familiarity, but it shouldn't be a deal breaker, I'll say.
Got it. So here's a question, because you raised this earlier, the fact that, it's tied to salary. So here's the question. What is the most tax effective compensation model to enjoy a pension plan? Is it taking salary only? Is it taking dividends only? Or is it taking a hybrid? What is the best model to take advantage of a pension plan?
Well, the minimum, by minimum, the owner of the corporation has to have a salary, as I mentioned before, because the contributions are based on somewhat on the RSP limits for contributions, but also they're tax deductible contributions, and the pension plan is considered an employee benefit. So if somebody is only paying themselves dividends, it's hard to justify that they're an employee. They're paying themselves as a shareholder. So the salary I use as a basis, and then if someone wants to actually lower their overall income taxes, they could top it up with some dividends. So we'll often work on a hybrid model with our clients to see what works best for them. But at the outset, we would always set up a certain minimum salary to allow them to contribute to their pension plan.
And so if my client is already on 100% dividend, because those were the old rules and we were helping our clients being the most tax efficient possible, and now with the new rules and the new reality, how can I remedy this?
Well, I would suggest that we have the conversation to switch them to a salary or a hybrid model. again, to be able to make those contributions to their pension plan under the law. Now, yes, I agree with you, 10, 15 years ago, paying oneself with dividends was more tax advantageous, but the change in the rules and the change in the tax rates for salaries and dividends over the years has made it that paying one or the other is probably going to put you in the same after-tax dollar situation that you would be. So I would definitely recommend that if they're going through with a personal pension plan, that they develop a salary and or hybrid strategy going forward.
Okay. And here's an important question that, again, my physicians ask me and their accountants as well. Is there a minimum, or what is the minimum corporate revenue needed that makes sense before setting up a pension plan?
Well, I get that question often, even when somebody decides to incorporate in the first place. Is there a hard and fast rule of, if I earn X dollars, thou must incorporate? And it always comes down to, what's your lifestyle? How much money do you need to live on? Because if you're going to earn money through a corporation and then take it all out to live on, then the tax system has it set up such, they even have a term, it's called integration, that if all you do is flush out all the money through the corporation, the combined tax that a corporation will pay plus your tax is going to be about the same as if you didn't incorporate at all. So the main advantage of incorporating these days is, if you're going to have any excess cash available, monies you don't need to live on that you want to set aside for savings, then it makes sense to incorporate. And then once you have the corporation, that's when we can turn these excess monies into a pension plan for you. Everybody has a different lifestyle. Everybody have different family circumstances. So we really look at the client's, I call it the household budget. How much do you need in after-tax dollars to live on? And then we determine, first, you need to incorporate, and second of all, with the corporation, are we going to be able to save this excess cash and put it into a CPPP for the future?
Okay.
Go
ahead.
Sorry, I think that a quick rule of thumb is, if you are maximizing your RRSP contributions every year, if after you've paid everything, you're still putting $30,000, let's say, into an RRSP, then automatically you would qualify. It would make sense to be in a pension plan in the CPPP. But if after all is done and paid for, you only have $100 left of disposable income to save, then maybe a pension plan is not that great of an idea. It could still make sense if you have RRSPs and you want to protect them from creditors, and you want to write off all the investment management fees. If you want to invest them in stuff that's not RRSP eligible, there might be all kinds of reasons to still have a pension plan. But typically, if we're looking at a minimum of $30,000 of disposable income set aside for retirement purposes with most of our clients.
Well, I mean, the idea is, if you have saved enough money, or that you've drawn enough money from your corporation on the personal side to actually pay and save in the RSP, you might as well do that in your corporate side pre-tax and do it in a pension. And so my idea is, if you're going to do an RSP anyways, you might as well do it pre-tax in the corporation.
Absolutely. And as I mentioned earlier too, with the RSP, you've got that conversion to a RIF that's mandated. So again, the CPPP offers you much more flexibility.
So this is another question that kind of asks the question a bit differently. So if my clients make 500 and they take the entire 500 to live on because of their lifestyle, and there's no retained earnings in the company, does it still make sense to set up a pension plan?
Yes, in the sense, if we can use some of that corporate dollars at first, before taxes, and this would allow this person to probably have a greater savings. But if they're earning 500 and spending 500 with zero savings, then yeah, we can't help that person. Or they're living paycheck to paycheck. But if the intent is to set up a retirement plan or retirement strategy, then yes, we would talk to them about setting up a pension plan if it warrants it within the corporation.
The only exception to that general principle is where someone has significant RRSPs and they set up a pension plan and they put their children inside the pension plan. Even though they're not contributing anything else after that, because they don't have to, the law doesn't force them to contribute because they're spending everything. All that capital can pass tax shelter to the next generation with no deemed disposition. And so that could be millions of dollars of value for the survivors, even though on an annual basis, the corporation really spends everything it earns. So there's these weird, rare cases that could still make the pension plan viable. But normally, as you said, if everything that comes in is spent right away, well, what are we saving? We're not saving anything. So not saving on RSP, not saving inside the corporation, not saving in a pension plan.
Well, my thoughts on this is a little bit different, gentlemen. Like if I'm making 500 and I'm spending 500, well, the 500 that I'm spending, I'm paying someone else first. I'm paying the mortgage first. I'm paying my Ford dealership first. I'm paying Enbridge first. I've paid everybody first, and if I have anything left, then I'll pay myself last. And so I'm of the mindset that I'm going to pay myself first. So out of the 500, you know what? I'm going to leave 30 grand for myself, for my future self, because I value my future Vu Quet Tran. So out of that 500, I'm going to put 30 aside, and I'm going to still spend the other 470. So at the end of the day, I still have zero retained earnings, but at least I've done the pension plan for myself. That's how I think.
Oh, absolutely. And this, it goes to that old joke where, you know, on your tombstone, it's, do you want it to read that I worked till the last day? You know, I kind of died. I died with my boots on, so I didn't need a retirement plan.
Okay,
I've yet to find anybody who wants to do that.
so here's the last question that I think is very important, because we've been talking about physicians and this is for physicians, but the actual plan itself, the structure, is beyond physicians. And so can accountants set up pension plans for themselves, given that they are also incorporated professionals?
Yes, absolutely. I did it. I'm living proof. Yes, it's available to accountants. It's also available to other professionals that are incorporated, such as lawyers and dentists and architects. Because we're, again, the whole premise is using corporate dollars to contribute to a pension plan. If you're in, you know, an incorporated self-employed professional paying yourself a salary, I don't see why you can't do that. And JP, I'll let you see if there's any legal wranglings with some other professionals.
No. We have all kinds of people from all walks of life. As long as they're incorporated, as long as they're under age 71, because you can't do this after you're 71. But as long as you're under 71 and you're still collecting a salary or a bonus or a mixture of the two from your own corporation, you're good to go. And what's interesting is that with the RRSP, all deductions and contributions cease at 71, because you're not allowed to contribute to a RIF, right? You can convert an RRSP into a registered retirement income fund, but you can't put money in a RIF. With a pension plan, even after 71, the company can keep making contributions and claim deductions. So that's really powerful, because you may have another 30 years worth of deductions beyond age 71 until you die. And that really helps, because that corporation that's putting money in the plan is yours as well. So if the money is growing inside the corporation, it's being taxed. Why not move that taxable money into a tax sheltered solution over those extra 30 years? So you end up with significantly lower tax bills at the corporate level.
Well, it's funny you made that joke, Normand, because as you know, physicians love to work, and they love to work until they die, whether they would need it or not. They just love to work. So we may be those people who are on our tombstone, we worked in our boots until we die, but not because we needed it, because we want to do it. And so the point that you made, JP, that if I want to work beyond the age of 71 and I'm still making OHIP money or money and it's coming in, I want to find ways to reduce my tax bill. So that's very important.
But not just OHIP money. Let's say you've put money in, you save money inside of your corporation. You open up a non-registered taxable investment account inside of your professional corporation, and you've been growing that wealth with all these retained earnings over time. Even though you're not collecting anything from OHIP anymore, because you've hung up your stethoscope, you can use that money inside the corporation to fund the pension plan after age 71.
Correct.
And a lot of accountants don't like that because they say, well, that's going to be taxable. If you sell those shares that's inside of the investment account, you're going to have a big tax bill. To which, Norm, what do we say when they say that?
Yeah, well, you offset the gains with the contribution to the pension plan.
So the tax rate is zero. In fact, it's less than zero because you will have typically tax losses. Not only you get zero tax at the corporate level, you've over deducted, so you may end up having tax losses, which can be carried back, I think 3 years, you're telling me, Norm?
Yeah, up to 3 years to recoup some of the taxes you paid in the past.
So free money from CRA or against future taxable income of the company. I believe it's indefinitely.
Correct.
And if that wasn't enough, and on top of making this super tax efficient, those shares that were sold, only half of it is taxable. The other half is a credit to the company's capital dividends account. And that allows you to pull dividends tax-free. So not only are you collecting a pension, you're getting tax-free dividends from your own company. Well, I can't do better than tax-free.
So this is, again, this is any time, but you can also do this beyond age 71, which is not allowable in the RSP model.
No.
Correct. Yes.
So that's huge.
Okay, gentlemen, those are the questions that I've had from the accountants. Are there other aspects or questions from Normand, from your perspective, from the accountant perspective, that we didn't talk about?
Not really from the accountant's perspective. It's more, again, I think our job to educate the financial planners out there that, that should also be pushing or educating themselves and offering these solutions to their clients. And so I've kind of made it my personal mission to work closely with financial planners that understand not only investments, but the pension and the tax implications as well. Because I think we'll all agree the tax implications themselves are such that the plan pays for itself. And who wants, who wouldn't turn down a free pension plan plus all the tax advantages that come along with it?
JP, from a legal perspective, is there anything we didn't chat about?
The elephant in the room is that when people realize what these rules allow Canadians to do, there's something in their head that says it's too good to be true. It's too good to be true. And if this was possible, I would have found out about this years ago. And unfortunately, there are lots of good things out there that people don't know about. Only a select few that are specialists in these areas have ready access to this knowledge. And other people, for whatever reason that we've talked about, they haven't been exposed to it yet. And so they're missing out. So our mission is to try to bring as many people under the tent as possible and let them use this legislation that's been around forever and take advantage of it instead of not using it. So
okay,
those are my final thoughts.
Okay, well, thank you very much. Thank you, Normand. Thank you, JP. It's been a pleasure. Now I know what to answer accountants who come at me with all those questions.
All right. It's been a pleasure, Vu. Thank you. Thank you, JP.
Thank you very much.
Bye-bye.